Hello class, welcome to the video. This video is your FA2 chapter 5 financial statement of limited liability company. So what you can learn in this chapter, upon completion of this chapter, candidates should be able to prepare the financial statement of a limited liability company, which include the statement of comprehensive income, statement of financial position, statement of changes in equity, and notes to the financial statement. So let's start. Here is the components in limited liability company financial statement. First, we have statement of comprehensive income. This statement of comprehensive income is very similar to your sole proprietor or partnership income statement, just that the preparation format is having some different as compared to your income statement in sole proprietor and partnership. And you will have statement of changes in equity, statement of financial position, statement of cash flow, and notes to the financial statement. And the statement of cash flow we will cover in chapter 7, so we will not discuss cash flow statement here. So what is statement of comprehensive income? Statement of comprehensive income have two parts. The first part is income statement, which is similar to the income statement in your sole proprietorship and partnership. The second part is the other comprehensive income, which disclose other gain or loss in limited liability company, which is outside the normal business activity. Typical example will be foreign exchange gain or losses in the investment in foreign subsidiary and revaluation gain or loss in the land and property. So here I enclose a sample of the statement of comprehensive income. So from here to here, we call income statement. This is the first part in your statement of comprehensive income. And then the second section here disclose the other comprehensive income. So let's have a look on the statement of comprehensive income and see what is the difference between statement of comprehensive income and your income statement in your partnership and sole proprietor. Let's start. So first one, still the same, we have revenue, but your revenue or sales should be net of return. It means that all the return inwards should be calculated inside this revenue. It means that you only present the net amount. Next, we less the cost of goods sold. The cost of goods sold combination is we using opening inventory, add purchase, add cost to bring in the product, less closing stock, and less return outwards. So similarly, we do all the working inside and we just provide a lump sum figure. Unlike to your income statement we have to show everything, right? But in the statement of comprehensive income, we group the working together, so we just give a one lump sum amount for the cost of goods sold. And then you will get your gross profit or losses. Other than that, you will have other operating income, such as your discount received, bank interest income, and etc. Next, you have to minus the distribution cost and administrative expenses. So what is distribution cost? Distribution cost is the cost related to your sales. For example, commission to salesmen, carriage outwards, those are considered as distribution costs. Next, administrative expenses. Administrative expenses is those expenses used to maintain the operating of business. For example, the salary for staff, your rental of your warehouse, and etc. After that, you will get profit before interest and tax, or we call operating profit. If you get a negative amount, then this will be a loss before interest and tax and operating loss. Next, number 5, we have to minus the interest expenses and finance costs. Unlikely to your income statement for your sole proprietor or partnership. When we prepare the income statement for sole proprietor and partnership, normally we include the interest expenses as one of the expenses here, right? But now we have to separate calculate. So these interest expenses or finance costs include what? Include the bank interest, and also include the preference share dividend. Okay, preference share dividend we consider as what? We consider as a finance cost. So include here. And after deduct your interest, expenses, and finance costs, you will get profit before tax. So if this is a negative amount, loss before tax. And then we have a corporate taxation. For sole proprietor and partnership, normally the tax will be the personal tax. It means that when you get how much from your business, after that you will recognize as a personal income tax, and then we calculate personal income tax only. But for limited liability company, because this is a separate legal entity, so we will charge corporate tax on a separate legal entity. So we will take a look later on how to recognize the corporate tax. And then after that we will have profit after tax. It means that your profit before tax minus your taxation, you get profit after tax. And we have complete the first section, which is income statement. Second section called other comprehensive income. So in your other comprehensive income, the typical example is your revaluation gain or loss in the land and property. So if this is again positive, loss negative, so you will get total comprehensive income at the end of your statement of comprehensive income. So a detailed explanation you can see in the next page, which is page 70. Here explain what are the meaning for each item in the statement of comprehensive income. So we look at number 5 and number 6. So number 5, interest expenses, finance costs are separately disclosed as compared to income statement of your sole proprietorship and partnership. Do remember that preference share dividend shall be classified under this category. Take note that for preference share dividend, you have to recognize as an interest expenses. Why? Because preference share we classify as non-current liability. So for non-current liability, the reward that we give to preference shareholder we classify as interest expenses. And for number 6, unlike sole proprietorship and partnership, limited liability company is required to pay its own taxation based on the taxable profit. In general, the income tax expenses will only be paid in the next financial year. Meaning that this year profit we only pay the tax next year, because you still need to time to summarize what is the taxable profit during the year. So this is the practice. This year taxation we pay next year. This year taxation we pay next year. Hence, the accounting entry for income tax will be we debit the corporate taxation, which is under your statement of comprehensive income, and credit to tax payable, which is under your current liability. And that's all for the explanation of statement of comprehensive income. The next statement that I'm going to share with you is statement of changes in equity. So what is statement of changes in equity? Statement of changes in equity is a statement to reconcile the difference between the opening and closing equity of a company. The following are the possible events that may result a change in company's equity. So we have issuance of share, right issues, bond issue, dividend payment. But take note, this dividend payment only for ordinary share dividend payment. Gain or losses in the revaluation of land and property, and transfer of fund in between the reserve. So this is a sample of the statement of changes in equity. You can have a look. So we will practice one exercise of the statement of changes in equity to let you familiar what is this. Classroom exercise 5.1. The following is the abstract statement of financial position of LKY Limited for the year ended 31st December 2019. So we have their ordinary share, share premium, revaluation reserve, general reserve, and retained earning. So these are the transaction and event happened in the financial year 2020. Prepare the statement of changes in equity for the year ended 31st December 2020. So I have give you a sample, you can use this, but for a better presentation I will use Excel to present my answer. So the financial year ended is for 31st December 2020, right? So the period is start from 1st January 2020 to 31st December 2020. So we start writing the opening balances. So we will write as at 1st January 2020. So first thing we do is we record the opening balances. For ordinary share, we have 500,000. Share premium 260,000. Revaluation reserve 80. General reserve 15. And retained earning 189,500. So this is the total we have, 1,044,500 at the beginning of the year. Next, we look at the individual adjustment to see whether we have to include in our statement of changes in equity or not. First one, we propose a final dividend 0.05 per share in 31st December 2019, and this amount has been declared and paid by the company on 31st March 2020. So we have learned the concept of dividend in our chapter 4, am I right? So proposed dividend. The proposed dividend is for 2019, and this is only paid in 2020. So this dividend we shall recognize in the year of 2020 transaction. But how to determine what is the total dividend we pay? So for this proposed final dividend, we base on 5 cents per share. So we have to determine how many shares in this company. So this is the adjustment one. The company share capital is 500,000, and the par value for each share is 50 cents. So we get 1 million of the ordinary share. And the total dividend, 1 million of the share times 5 cents per share. So how much we get? $50,000. So the total dividend we paid is 50,000. So let's record this. Dividend paid. So dividend paid is utilizing the retained earning of the company. So we put a negative because this will reduce the retained earnings of the company. Next, on 31st March 2020, the management offered a bonus issue to its shareholder on the basis of every 2 shares. Sorry, they give 2 shares if you have 5 shares held on your hand. The bonus issue is utilizing the share premium account. So on this date, the company offer bonus issues to the shareholder. So on the basis of if you have 5 shares on hand, I give you 2 shares, and this amount is utilizing the share premium. So for this working, we have to identify how many shares or how many bonus issue that we give to our shareholder. So second adjustment. So from the previous adjustment, we know that the company is having 1 million of the shares, right? So the bonus issue is if you have 5 shares, I give you 2. So we divided by 5 and times 2. So answer, 400,000 shares. And what is the value of this bonus issue? So our bonus issue will be 400,000 shares times the par value per share, which is 5 cents. So total 200,000. So let's reflect this in our statement of changes in equity. So our ordinary share capital will increase by 200,000, and then share premium will reduce by 200,000. So 181 minus, so there is no impact in the equity of the company. There is no influence in the equity of the company. Next, on 30th September 2012, the right issues on the basis of 1 share for every 5 share held at the price of 0.75 each. The right issues has been fully subscribed by the shareholders. So we have to determine how many right issues that we offer or we sell to our shareholders on 31st September 2020. So let's look at the working. So first we have to identify how many shares that we have on 30th September. So on 30th September 2020, how many shares that the company have? So this is the opening share that the company have, 1 million plus the 400,000. Where to get the 400,000? Here. You may ask a question, sir, why we need to include the 400,000 when we consider the right issues? Because this bonus issues is happened on 31st May 2020. And the original share that we have is 1st January 2020. So when you consider your right issues on 30th September 2020, you have to include, because your right issues will consider all the issue share up to the right issue date. So the total shares that in the company is 1.4 million. And how they allocate the right issues? If you have 5 shares, you can buy 1 at the price of 75 cents each. So we have to figure out how many right issues during the period. So we use 1.4 million divided by 5 and multiplied by 1 to get the number of right issues. So the number of right issue is 280,000. Next, we have to consider how to allocate the collection from the right issues. We know that the issue price is 75 cents. The par value is 50 cents. From here, we can know that the share premium is 25 cents each. So the working will be in this way. For the ordinary share capital, we use 280,000 times 50 cents. For the share premium, we use 280,000 times 25 cents. So will be 140,000 and 70,000. So total collection from the right issues will be 210. So let's reflect this in our statement of changes in equity. $140,000, 70,000, and no adjustment for the rest of the account, and total collection or increase in the equity is 210,000. Next, on 31st December 2020, the fair value of the property has been changed from 420,000 to 450,000. So for number 4, this is fair value on the property. So the book value of the property is 420,000. The fair value of the property is 450,000. So from 420 to 450, increase or decrease in fair value? The answer is increase in fair value, and the increased amount is 30,000. So we have to reflect this increase in fair value in the revaluation reserve. This has been covered in your FA1 chapter 5. So if you're still not familiar with your fair value adjustment, you can have a look in your FA1 chapter 5 video. So revaluation gain on, this is property. The increment is 30,000. So this 30,000 we indicate in the revaluation reserve. Next, on 31st December 2020, the management proposed a 5% final dividend for the financial year 31st December 2020. We understand that for proposed dividend during the year, we no need to record in the current year financial statement. Why? Because the proposed dividend during the year will only declare or pay in the next year. So we are not required to disclose or record in current year financial statement. Next, profit after tax during the year, the financial year is 81,900. So for the profit after tax, we record on the retained earning 81,900. And class, take note on this. Where to get this profit after tax? We use this information, profit after tax. Do not use the total comprehensive income, because the total comprehensive income will include the gain or loss from the revaluation of property. And this revaluation gain or loss in your property has been included separately. So we only include profit after tax when we record in our return statement of changes in equity. Take note on this. Alright, I repeat, we only extract profit after tax in our retained earnings rather than using the total comprehensive income, because this revaluation gain in the land and property has been separately recorded under the revaluation reserve. If you record the full amount, the total comprehensive income, it means that you have double record the entry. Take note on this. And the last one, transfer from retained earnings to general reserve. The general reserve shall be at the value of 20,000 at 31st December 2020. So class, you have to pay a very good attention, or has to be very cautious when you look at the wording here. You see this, the general reserve shall be at the value of 20,000 rather than transfer 20,000. So how to make your general reserve? This should be 7. How to make your general reserve from 50,000 to 15,000 to 20,000? How much you need to transfer? You need to transfer 5,000 to make your general reserve from 15 to 20. So if you transfer 20 here, it means that your general reserve will change to 35, so you are not follow the requirement. So for the transfer, so transfer is from retained earning to your general reserve. It means that they will not have any impact for your total equity. So that's all. And this is your total equity at the end of the year. So we indicate as at 31st December 2020. So basically we have complete our statement of changes in equity. And last section we will explain the statement of financial position. Statement of financial position is used to disclose the asset, liabilities, and equity of a company as at its financial year ended. There is no big difference between the statement of financial position of limited liability company and sole proprietorship or partnership. So you can see there is no big difference. We're still using the same format to prepare our statement of financial position for limited liability company, sole proprietorship, and partnership. And the only things that you have to take note is this: preference share. Preference share is under non-current liability. Don't record this under equity, okay? And you can see the percentage here, right? Normally the percentage here refer to the dividend rate. The percentage here refer to the dividend rate. The percentage indicated in the preference share and term loan refer to is dividend or interest rate. Preference share shall be disclosed under non-current liability. And for the equity, for this section, you cannot follow trial balance. You have to follow the latest balance in your statement of changes in equity. If you use this figure in your statement of financial position, then your answer will be wrong, because this amount is without adjustment. You should use after adjustment amount. So that's all for our part 1 video in your chapter 5. The next video, we are going to discuss classroom exercise 5.2. So I will see you later. Thanks for watching.